We are now at the beginning of the summer months in 2026, nearly halfway through the year. The market started off rough, but rallied hard in the months of April and May. AI continues to dominate headlines. Investors are trying to figure out where are the next opportunities. So, as I continue to build my portfolio with fresh money I will be putting to work throughout the remainder of the year, a question I often get is, what are some stocks you're targeting? And in today's video, I'm going to be sharing 5 stocks that I believe have some of the most compelling risk reward opportunities as we move through the second half of 2026 and beyond. And what's interesting about this list is that these companies aren't all competing in the same industry. Instead, each one benefits from a powerful trend that I believe could continue driving growth for years to come. We're talking about AI, cloud computing, fintech, financial brokerage, energy infrastructure. So an array of different types of stocks to choose from. So with that being said, let's jump right into the video with stock number 1, which is going to be Amazon, stock ticker AMZN. Amazon remains one of my favorite large cap opportunities. Many investors think Amazon is e-commerce, and rightfully so. I feel like the Amazon truck is at my house at least twice a week. But increasingly, that's not the real story. The real story is AWS. Cloud computing remains one of the most important technologies powering the modern economy, and that was before AI even came about. AI is now accelerating that demand even further. Companies need computing power, storage, and AI infrastructure, and Amazon is one of the largest providers in the world. What's exciting is that Amazon has multiple growth engines: AWS, advertising, e-commerce, AI services, subscriptions. Few companies have that combination. And on top of all of that, they're building their own custom chips that are already receiving orders. Over the past 12 months, shares of Amazon are up 15% and currently sport a market cap of $2.7 trillion, already making it one of the largest companies in the S&P 500. This is a stock I've mentioned on multiple occurrences at specific times when seemingly the stock just got too cheap. And for me, I don't like to look at the stock from a PE ratio standpoint. Instead, I prefer the angle of EV to EBITDA. And anytime in the past year, EV to EBITDA has dropped below 15x, I've labeled that stock a buy. Looking here at the screen, you can see the stock currently trades at a forward PE of 29.5 times and an EV to EBITDA of roughly 17 times. So right now, this is not a raging buy for me. Again, this is a top 5 position for me already, so I do want to be a little bit more conservative. But what level would I be a buyer again? Below that 215 per share level. Why, you might ask? Because that would put the company back at an EV to EBITDA of around 15 times. And for me, Amazon remains one of the highest quality businesses available in the public markets. The company's free cash flow has dwindled down, but I am looking at over the long term where it will explode higher because of the investments they are in fact making. Again, the goal is always to build large positions in high quality stocks at great valuations. And to find those quality companies, it's easiest when you have the right tools that can help you find the right answers. One of those tools I've used for a number of years has been Seeking Alpha. Seeking Alpha has a number of great resources, but their premium subscriptions is where so much value is found. One of the greatest features they have is their health check. I utilize that on a regular basis. And right now, they're actually having their limited time summer sale where you can receive up to 25% off all of their key products, premium subscriptions, alpha picks, or you can bundle the two together and receive nearly $175 off an annual subscription. So make sure you take advantage of this limited time sale using my link down in the description below. All right, with that being said, now let's jump to stock number 2, which is going to be Advanced Micro Devices, stock ticker AMD. AI spending remains one of the biggest themes in the market. That's no secret. And while Nvidia gets most of the attention, AMD continues making progress in AI accelerators and data center solutions and has a lot more momentum than Nvidia. AMD shares have exploded for a 300% gain over the past 12 months before taking a bit of a breather, a much needed breather. And the reason I like AMD is simple. The AI opportunity is massive, and I don't think there becomes a winner-take-all market, and investors are starting to catch on to that. The demand for compute power is so large that multiple companies can succeed. AMD already has strong relationships, proven engineering talent, competitive products, and a superb management team. From an earnings perspective, shares currently trade at a 40x earnings multiple for 2027, which on the cover could sound high, but that's certainly not the case when we're talking about a company generating 75% earnings growth in both 2026 and 2027. With those growth rates, we are talking about a stock with a PEG ratio that's well below 1. And this is the wild thing about investing. We just looked at a stock that increased in value by more than 300%, and we're still labeling it intriguing or even cheap. Far too often, investors make buy and sell decisions simply based on a stock price movement. Stop. Buy stocks at good valuations. Sell stocks at poor valuations. Nothing should be predicated solely on what a stock price has done. And for AMD, if the AI spending continues at anything close to the current pace, AMD could be one of the biggest beneficiaries. So where do I want to be targeting a buy here when it comes to AMD? Well, I like the current valuation, but when I look at the technicals, I see a high RSI, a bearish move in the MACD, and an unfilled gap down to that 360 level. As such, that's an area I would be looking to buy shares of AMD. And now let's move to stock number 3, which is going to be SoFi Technology, stock ticker SOFI. SoFi is going to be one of those more controversial names among the audience. Some love them, some hate them. Many investors still think of SoFi as a student loan company. I think that view is very outdated. SoFi is becoming a full financial ecosystem, and I believe they will become a sector-altering company in the finance world. Will it happen overnight? No. Will there be bumps along the way? Absolutely. It's part of the process for every great company. And one area the company is thriving is the diversification of their product offerings. Today, the company offers banking, investing, lending, credit cards, and financial services. The key advantage is cross-selling. As members join the platform, SoFi can introduce additional products and deepen their relationships. Right now, SoFi has a market cap of just $21 billion, still a relatively small company in the financial market. And over the past 12 months, shares are up 17%. But in 2026, they're down over 40%. That is part of the volatility that comes with a company like SoFi. But as investors, we need to focus on the facts. And the facts are, SoFi continues to expand its revenue year in and year out. But more importantly, they are building their member base to more than 3.9 million. More members allow them to cross-sell, which allows them to generate more revenue. If management continues executing, I believe the market may still be underestimating this long-term earnings power of this particular business. So where would I be a buyer for shares of SoFi? I like the $15 level. I believe it's enticing, and that's an area that I've sold a lot of cash-secured puts at within my investing community. So with that being said, now let's move on to stock number 4, which is going to be Robinhood, stock ticker HOOD. Robinhood has quietly become one of the most interesting financial technology companies in the market today. Years ago, many investors dismissed Robinhood as a meme stock platform. Today, the story is much bigger. The company continues expanding into retirement accounts, wealth management, cash management, international opportunities, and now even prediction markets. And importantly, Robinhood is benefiting from a growing culture of self-directed investing. Take the example for the new Trump accounts for kids, which users must sign up on Robinhood to take part. Now, they have the freedom to move to another brokerage, but once you go through all of the work to sign up on Robinhood, the number of people that are going to go through that and then switch the assets out is likely minimal. As more people take control of their financial future, a platform like Robinhood stands to benefit, and they are exceptionally popular among the younger generations. When it comes to Robinhood, they currently have a market cap of $74 billion, and over the past 12 months, the stock is up around 10%. Yet in 2026, shares are down roughly 30%. From an earnings perspective, shares trade at a 35x multiple using 2027 estimates, with projected earnings growth around 35% next year. And in terms of a buy price target for me, if shares drop down to $65 or less, I would be buying pretty heavily. And for me, I would likely look to sell the July 17th $65 put. I'm going to get paid to wait to buy a stock I want to buy at a price I want to buy it at. Options is what takes your investing to the next level. And by entering that, I'm going to generate around $175 per contract on that trade. And if you're interested in seeing all of my option trades, then make sure you join my investing community, the Stock Investor's Edge. Check out the link in the description below. And getting back to Robinhood, I believe many investors still underestimate how large this ecosystem could in fact be for them. The company could very well become one of the largest financial institutions in the world over the course of the next decade. And with that being said, now let's move on to stock number 5, which is going to be Bloom Energy, stock ticker BE. Now, this final stock is not for the faint at heart, because with this stock comes heavy volatility. This is a stock that from the end of March to the end of May climbed over 170%. But since reaching those highs, the stock has dropped over 20%. Regardless, this may be one of the most interesting AI infrastructure plays on the market today. Everyone talks about AI. We know it's real. and we know the money is being poured into it for chips and data centers. The problem is the fact that very few investors talk about the power. AI requires data centers, electricity, computing infrastructure, and power demand is only rising and rising rapidly. Bloom Energy helps provide energy solutions that can support growing electricity needs. This is what I call a second-order AI investment. It's not directly building AI, it's helping support the infrastructure that makes AI possible. Look here at this chart for Bloom Energy. The stock currently has a market cap of $81 billion, and over the past 12 months, shares are up over 1,000%. Now take a look at these growth figures that are expected over the next few years. 180% EPS growth this year, followed by 105% growth expected next year. And using those 2027 earnings expectations, the stock trades at a 67 times earnings multiple. In terms of a buy price, my target, because this stock is volatile, I do want to be much more patient with the price target. So I would be looking to buy around $175 per share, which is where there is also an unfilled gap when looking at the stock chart. The thing that's interesting about all 5 stocks that we've looked at today is the fact that they benefit from different aspects of the same broader trends. Amazon benefits from cloud and AI infrastructure. AMD benefits from AI compute demand. SoFi benefits from fintech adoption. Robinhood benefits from the growth in self-directed investing. And Bloom Energy benefits from the rising power demand from AI. Different businesses, different industries, but all positioned to benefit from powerful secular trends. Now, does that mean all the stocks will go straight up? Of course not. There will be volatility. There will be pullbacks. There will be periods where the market questions these businesses, but we will be ready to buy. But when I'm looking for stocks to buy for the rest of 2026, I'm looking for companies tied to trends that could continue not just this year, but for years to come. And all 5 of these stocks are near the top of my watch list. And again, if you want to know exactly when I'll be buying these, when I enter the trades, make sure you join my investing community, the Investor's Edge, using the link in the description below. And if you enjoyed this video and found any value, please show your appreciation by simply clicking that like button down below. Subscribe to the channel. Thanks again for watching, and we'll see you in the next one. Take care.